to be honest, right now, the Fed, the whole system needs to actually see job losses right now. If you basically, we need to continue to slow the economy, so hopefully inflation comes down. That's the belief that the Fed has. Now, whether that works or not, we'll see how that all plays out. But that's the belief. So continue to slow down the economy. The Fed's even talked about unemployment rate going to the 4s or something like that, right? So we don't want to see it necessarily fall off the rails like we did in the Great Financial Crisis and go to 9%, 10% unemployment rate, something like that. But ultimately, the Fed does need to see job losses before the Fed can be done really in this game. They need to see CPI continue to come down, core CPI continue to come down, and they ultimately need to see job losses. And so with some of these sectors starting to experience job losses, you could continue to see that for the next, I would say, maybe quarter or two. If you remember back to specifically 2021, there was basically, it was kind of like a war for employees, essentially. And the big tech companies, I think, were the quintessential, companies that were doing this, essentially. All the big tech companies were just hoarding workers, literally, and just hiring people. And some people didn't even have roles, right? You heard the story there that they said about the guy who didn't even have a job. He was employed, but he didn't even really have a role in the company. He's like, what do I even do? You know what I mean? And I'm sure every single one of the tech companies had a lot of people that were just not even necessary. It just was like, let's hoard workers right now. And that was a whole movement there in 2021. Okay. And yeah, those days are long gone now. Assets have gone down a lot, right? Depending upon where you've been at. I mean, a lot of stocks are down heavily. Crypto's down heavily, right? So if you had investments, those have gone down. What about if you just held cash? Well, your cash is certainly not worth what it was worth 3 years ago or 5 years ago, right? So, because of obviously massive inflation we felt over the last several years now at this point in time. Like $1 million today is not what $1 million was, let's say, 3 years ago or 5 years ago, or certainly 10 years ago, right? And so naturally, when you have an environment like that, like people start saying, oh, shoot, man, maybe I need to go back to work. Maybe I need to start having an income, something like that, right? So I think that's something. Maybe there's a few buy the dippers out there and they're like, hey, man, a lot of stocks on discount here. The indexes don't really, they're giving a little bit of an illusion that the stock market's higher than it really is. But when you dig beneath the surface, below the top 20 biggest stocks, you start to realize the stocks flooded in the market right now that are 52-week lows, multi-year lows, all-time lows. And there might be a few people like that. I don't think that's a very big percentage, but it might be a few smart ones out there that are like, now might be a good opportunity to make some money and go ahead and put that money into, let's call it some of these positions. The stock market, companies, they need to see this happen, not just from the Fed perspective, but also because there's been obviously a huge movement up in wages, right, which hurts companies' profitability. And you say, okay, well, what if a company just raises prices? Okay, that adds to the inflation problem. So if I have to pay a worker $25 an hour to get them through the door instead of $18 an hour, right? Now either my profitability is hit, which obviously hurts, the way that company's valued, or I have to raise price on my customers, right? If I raise price on my customers, then that adds to the inflationary environment we're in, right? And so it just kind of is like this cycle. It just is a vicious cycle to get out of. So this is why ultimately the labor market, if anything, I think a lot of folks are out there rooting against the labor market in the short term, which is counterintuitive to almost any other normal time out there. The banking system can't function with 4% rates. Looking really forward to this one. I was hearing in the back half of 2020 and into 2021, or early 2021, inflation was already out of control. The data wasn't showing it. But every single person I knew that ran a small business was already telling me how much prices were going up. This is at the end of 2020, beginning of 2021, way before the Fed was even considering being worried about inflation, right? And so that was a moment I think the Fed should have already started to at least consider, we might have to start moving up rates here. We might have to start actually fighting this and talking about this, right? And then they could have continued that through kind of like the middle of 2021 and the end of 2021, and we could have had a more gradual increase in rates. We might never have had to go as extreme as we had to go, but because the Fed kind of kept the sloshing of money out there, right? And they weren't in reality, and they were looking at backwards looking data, and they were disconnected from what's going on in the real world. Ultimately, they lagged by probably a year, if not more than a year, when they should have been ultimately making moves there, okay? And so that's my opinion, but how do you get those folks to get into the real world? I don't know. That's a problem, okay? That's the issue. Avant Brands, the smallest cap company I personally own, right? This stock has been absolutely pummeled, and it hasn't deserved to get what it's gotten, essentially. Okay, there's a lot of smaller cap companies that deserve to get absolutely pummeled in this market. I can tell you this isn't one of those companies. When you see these sorts of moves there, right, you're like, oh my gosh, it must be in a bad position. This company right now, okay, is basically, it has about $35 million of stockholder value, stockholder equity, okay? Stockholder equity of about $35 million US. That's less than the market capitalization of the company right now. You don't see that very often, if ever, with a company. And if you ever do, it's usually because the company is, the revenues are plummeting and people think they're going to go out of business or something like that. That's not the situation with Avant. They're actually cash loaded when it comes to this company, right? As well as they got a lot of inventory because they've been growing their business. But not just that, the company's a growth beast. And so this is the furthest thing from a company that should be trading at basically stockholder equity, stockholder equity being higher than the market cap right now. Like that should never happen for a company that has this sort of growth. That's just ridiculous, right? They did $22 billion of revenue this past year versus $11 billion the previous year. That's incredible growth for an MJ company like this, right? Now, in terms of their bottom line, right? It's being hurt by a few things. Depreciation and amortization definitely hurt them. And also share-based payments this past year definitely hurt them as well. But if they can get on their own 2 feet as far as that net income loss goes, oh my gosh, the upside here for Avant is absolutely ridiculous over the next several years, right? And so the way I kind of see this stock playing out is I think it's going to bottom likely here in the second quarter of the year, and I think it's going to start to uptrend in the second half of 2023 and kind of move from there as they continue to make progress on the bottom line there, and if they can start showing profitability for this company. I mean, imagine if they can just get to a point where they start throwing off $1 million or $2 million a quarter in net income. I don't think that's out of the realm of possibility for them to get there pretty soon, right? And I mean, when you start thinking about if they do 1 to 2 million positive net income a quarter on a market cap of 32 million, do the math on that and run that over a year, and you begin to understand why this market cap could explode higher over the next few years if Norton and the team can kind of put together what I think they can put together as far as that bottom line coming together. So yeah, I think this one's a tremendous buying opportunity for if anybody's actually interested in something super small out there. It's definitely at least a stock to watch, right? Pfizer stock, PFE, great dividend company. Obviously, biopharmaceutical giant. Stock's been hit very heavily, and it's actually a great opportunity to be a buyer of this stock, okay? It's a cheap company. I mean, trailing PE 7, forward PE 11 on this company, right? And obviously, they got a huge boom from Rona. We all know that, right? And which that has faded off now at this point in time. But remember that all that money they made didn't just go invisible, okay? That money's still there. Let's just put it that way, okay? Huge dividend payer on this one, about a 4% dividend yield, right? Payout ratio under 30% for this company overall. Strong pipeline for the company. And so I look at a stock like Pfizer as a tremendous dividend buying opportunity here. Likely good, nice capital appreciation over the next few years. And I think this is kind of the perfect storm to be a buyer of a stock like this when, kind of everything's down and out here, okay? Last stock up here, number 10 of 10. This one is, we call this a get rich or die trying stock, okay? This is by far and away the riskiest stock of the bunch, okay? Every other stock I named on this list is not risky at all, in my opinion, if you have a 3 to 5 year time frame. This last one is more of a fun one, okay? This is what I call get rich or die trying, because this stock is high risk and insanely high return depending upon how things go here, okay?